What's going on, everybody? Thank you so much for checking in. In this video, we're going to go over 4 different small account friendly companies in which we find to have strong upside potential in the coming quarters and the coming years. These 4 different companies are in 4 different sectors, so it's a great way to diversify across a variety of industries for one's portfolio. The first company is United Natural Foods. Then we have APA, which is an oil or energy company. Then Bumble, which I'm sure many of you single people are familiar with. And finally, we have Toast, which you've probably seen at your favorite restaurant. Let's go ahead and get started with the number one name on our list, which is UNFI. And by the way, this is the number one name on our list for a reason. This is a company that's bringing in more than $30 billion per year in revenue. When we look at their annual revenue, it has only grown over the last 7 years, and so has their balance sheet in a healthy manner. This is a company that's valued at $842 million. And so ask yourself, if a company is making $30 billion a year in revenue, yet it's valued under $1 billion, what's going on? Is this a name that Wall Street just has not noticed yet? And I think that is the case here. Because when we look at their history, this company does not have any outliers in which we may see as a red flag. This company has purely grown. The only negative years they had of profitability were during COVID. But since then, you can see that the company has snapped back. Yes, 2023 was a low profit year. However, we expect as interest rates come down, and by the way, this is a point that applies to all 4 of these companies. When interest rates come down, these companies are bound to start making profitability. What you're going to notice is that a lot of small cap and mid caps companies and stocks are struggling to maintain profitability and grow their profitability because of high interest rates. When interest rates come down, it makes borrowing less expensive, and so these companies will grow their bottom line and they will become even a more attractive buy. And so as you're buying these companies and as we talk about them, keep that in mind, because when we look at their earnings projections, you're going to see that their profits are expected to grow. And the reason why is not because these companies are only naturally growing because of their great business models, but also their profitability is growing because interest rates are coming down. Now back to United Natural Foods. Apart from their revenue growth, which is extremely impressive, the company does also have a pretty reasonable balance sheet for being a distribution company. This is a company that engages in the distribution of natural, organic, and specialty foods. Anytime it is a distribution company, the assets to liabilities are not going to be so much more assets than liabilities. You're going to see a 1-to-1 ratio. Now, typically when we invest in a company, we like to buy companies that have at least a 2-to-1 ratio when it comes to assets to liabilities. So that would mean they would need to have 12 billion in assets and about 6 billion in liabilities. That's not the case here for United Natural Foods, and so we do have to make note of that. But because it's a distribution company, we can forgive them for not having so many more assets than liabilities. Finally, free cash flow is currently at -46, but they did come out with about $300 million last year. This is a decent number for a small company. It doesn't mean that they're going to pay investors a dividend anytime soon, but it does mean that they do have some kind of breathing room in case of a unexpected or a black swan event. So going back to their market cap and going back to their revenue growth, when a competitor may look at this company, imagine Kroger or a big conglomerate that's involved in the natural, organic, or specialty foods industry that has billions and billions of dollars to spend. Imagine a company like Natural Foods popping up on their radar and they see that this company is only worth $842 million. But when they look at the numbers closer, they're seeing that this company is making more than $30 billion a year. This automatically qualifies this company for a potential buyout. So if I was a big conglomerate and I saw this company and I liked the way that they're doing their business, the company is shipping well, the company has a great distribution system, then I would automatically make a bid for this company at a higher price than it is right now. Now, I'm not saying that will happen, but it is something that may happen given the fact that this company is awfully cheap compared to what they're bringing in. So UNFI is the number one on our list for that reason. Let's talk about where we're buying the company. So unfortunately, we did already get into this company, but if you missed the initial entry because you're not part of our group, it was back at $12.12 around June 3rd of this year. Our price targets are still far away at 17 and 19. So if you are looking to get in, you would want to get in somewhere above this 835 mark. As long as this company is consolidating here between 835 and 17, then it is in a healthy range. You'd want to get in between this range, and you'd want to wait for that 17 breakout to take your first profits. And then as the company goes higher, we do expect it to begin filling in this gap that it made back on in June of 2023 towards $23 to $26. So those would be our first price targets to start in the coming quarters and the coming years. Now the next stock on our watch list is going to be APA. This is an energy company. It is the next stock on our watch list, and we rank it number 2 on this list because we are very bullish on energy in the coming years. You have to remember that OPEC, which is let's call them the mafia of oil, these are different countries that control oil supply. They have been working tirelessly and cutting production in order to raise oil prices, but oil prices are just not giving. However, given the fact that there are so much geopolitical pressures, tensions in the Middle East, and overall oil and energy demand, we expect oil and energy to have a latent response or a delayed response to everything that's happening right now. And APA is one of those companies that's at the top of our list in terms of buying. As you can see, the company is trading near its 52-week lows, and buyers are trying to sustain it above. Now, when we're buying these companies, it doesn't necessarily mean that these companies are going to reverse right away, or their stocks are going to go on a multi-week and a multi-month rally right away. These are companies that are undervalued, and it will take time for them to catch Wall Street's eyes because they're not your Nvidias, they're not your Apples, they're small mid-cap names, and they take time to catch up to the rest of the market. Now for APA, let's go ahead and take a look at their numbers and see why we're liking this company. When we pull up their numbers, remember what we already did with UNFI. We went and took the revenue and we multiply it by 10. And so in 2023, this company made $8.28 billion. So if we take $8 billion and multiply it by 10, that gives us $80 billion. Why did we just do this formula? If you are looking to see if a company is overpriced or oversold in terms of its market cap, you can take their current annual revenue and multiply it by 10, which in this case is 80 billion, and compare it to their market cap, which in this case is $11 billion. If the company is expected to make more than its market cap in the coming 10 years, then this company is considered to be potentially underpriced, with many other things in mind that we'll talk about. But for now, right off the bat, the glimpse of an eye, APA is a company in which is overvalued. Obviously, they're projected to make $80 billion in the coming 10 years, but they're only valued at a market cap of $11 billion. Now, APA also has a price to earnings ratio of 3.3. When you are looking at a company and you're trying to figure out if a company's price to earnings ratio is healthy or not, you want to use the 15 to 25 scale. On the lower end of that scale, that company becomes more and more attractive because it's considered to be a cheaper buy in comparison to what the company is profiting. For APA in specific, you can see that number is far below 15, right around 3.3, making it even a more attractive buy. This company also rewards its investors by paying them a dividend of about 25 cents per quarter and has historically raised its dividend, keeping everyone happy. When we look at their profitability, yes, it has been a little inconsistent, but nonetheless, over the last 3 years, this company has managed to pull it off and bring a positive net income. Their assets to liabilities also have a positive 1.5 to 1 ratio. And last but not least, they do still have free cash flow enough to satisfy their dividend and potentially raise it in the future. When we are looking at APA, given the fact that it's at its 52-week close, we may see further lows towards the 22.75 mark. We're not opposed to entering the stock right now, but we would want a bigger position around 22.75 if it gives. The first breakout point is going to be around 36. Above that point, our price target is going to be around 46, in which we would begin taking profits. And the second price target would be around 52, which would be our second price target. The next stock on our watch list is going to be Bumble. Now, Bumble is one of those names that is a little bit high risk, high reward, just because there's nothing proprietary about them. But they have really managed to keep their skin in the dating game for quite a while, and they actually swung into profitability, and they're expected to continue posting profitability in the coming quarters, which is what we like about them. Remember what we said in the beginning of this video. As interest rates come down, these companies are expected to post bigger profits. So on Bumble, United Natural Foods, and APA, we are seeing that profitability is expected to go up. And one thing to keep in mind about the market is that it does not care about what happened. It only cares about what's going to happen. And so if in the future these companies are expected to continue growing their profits, then lo and behold, the market is likely going to push them higher. Now back to Bumble, let's go ahead and take a look at their stock and what they're doing in terms of revenue. Bumble here in this case, you can see is bringing in about $1.5 billion annually. Now we're going to take the same exact formula we tried on the other stocks and we're going to multiply this number by 10 and it's going to give us $10 billion. Now let's compare that to Bumble's market cap. Bumble's market cap is around $1.38 billion, so that's significantly lower than what they're expected to make over the next 10 years. Keep in mind, this is not a company that we would necessarily hold for 10 years. This is more of a play that we would take on for a few months or a few quarters. Specifically for Bumble, we'd like to take it on over the summer. We're expecting this company to see a lot more action during the summertime travel and of course all those single people trying to date. And so this is more of a trade that we take during cycles in which we expect it to see an upswing. For Bumble in specific, you can see that this company continues to suffer. It has been selling off ever since it went public and it is now trading below its 52-week, near its 52-week close. Now, with that being said, if you are looking for a support, we're going to place our support at 9.83, which is the lowest point it has reached lifetime to date. The resistance in our way is going to be 1250. So above 1250, we're going to put a resistance on Bumble with the plan to break out above that level and continue moving higher towards the first price target of 16. Now above 16, we expect the stock to move towards 21, and that's about as high as we expect it to go. So that means our price target above 16 is going to be between 19 and 21. Last but not least, the final stock on our watch list is going to be Toast. Toast is one of those companies that reached a new 52-week high this year but has pulled back since, but we're still seeing opportunity in the company during summer and as their growth continues to be impressive. Let's go ahead and take a look at Toast. Let's go ahead and switch this over to the hourly. We already laid out this chart for you guys. And we're first going to talk about their revenue. And if you don't know what they do, this is a company that provisions consumer payments in restaurants. If you go to a restaurant next time, especially if it's a small time or a hole-in-the-wall restaurant, you'll probably see that Toast is one of those companies that's operating their payment processor. Let's go ahead and do our 10-year test on Toast. We're going to take their annual revenue, multiply it by 10 at $4 billion. They're expected to make $40 billion over the next 10 years, assuming that they do not grow at all in terms of year-over-year revenue. But you can clearly see this is a company that has grown in double-digit percentage points. One year they grew triple-digit percentage points over the last 4 years, which is a very impressive thing to do. Profitability has been extremely difficult for this company, so as of right now, they have a negative price to earnings ratio, which is something you want to keep in mind. This is a high risk, high reward kind of investment. But as interest rates are expected to come down, Toast is actually expected to start posting profits in the next 4 quarters, which means they would have moved away from extreme negative quarters to finally breaking positive, which is going to attract a lot of investors. For Toast in specific, we are looking for entry around the 2150 mark would be our first mark. You can see it's retesting this trend line. If it breaks below 2150, we would consider adding shares around 1840, and then we would set our stop loss just around below that point if it breaks lower. Resistance in our way is 2515, and these are the 2 price targets above that level that we would consider taking profits at. So thank you guys so much for checking in. I hope you guys found this video helpful. Don't forget to subscribe, and please do your own due diligence. You need to fall in love with your investment in order to continue holding it through the ups and downs. And so make sure you really like these stocks before you go out and blindly buy them.